Welcome to the at-home edition of the Stock Play of the Day. We're going to talk about Google's parent company, Alphabet. We'll discuss, should we pass or should we play? Hello, everyone. My name is Brian Overby. I'm the Senior Options Analyst at Ally Invest.
And I'm Lindsay Bell, Chief Investment Strategist at Ally Invest.
Well, Lindsay, we've had a couple of green Mondays in the S&P 500 index, and we also have a very busy week as far as earnings are concerned. What else is going on in the marketplace that you see?
Yeah, this morning, we've got the S&P 500 in the green, despite another pretty deep down red day for the oil market. But, I think what investors are looking to is, first and foremost, like you said, it's going to be the busiest earnings week of the season. But also, there's optimism out there right now about the opening of certain states where they are allowing businesses to restart and reopen. There are talks of plans in other states of how they might reopen. We heard Governor Cuomo here in New York talk about the different phases that businesses would have to go through here to reopen. And so I think investors are really just encouraged about that. You're starting to see countries in Europe come up with plans for reopening. So again, optimism out there too, optimism that we may come up with a drug that could either cure this or at least make it a little bit easier to live with. So those are kind of some of the bigger things today. It's a little bit of a quiet Monday, but you see the market is up. I know though that we've been drawing these technical lines over the last several weeks here that you're showing that you wanted to look at too. This is interesting too, that we're coming into a green Monday, but that's also after a down week in the S&P 500 and the Dow, which it's been a couple of weeks. Down, it wasn't down last week, Brian, was the Russell 2000. It was actually the strongest performer of all the major indices last week. What do you make of that and the technicals you're seeing in the S&P 500?
Well, yeah, we had the VIX come in a little bit. We're seeing volatility drop off a little. And also if we look at the chart now, last week we mentioned the fact that we got back to the 50% level after the big downturn. But now I'm going to actually highlight that using the Fibonacci tool inside the Ally Invest charts. It's highlighted here in green, and I just kind of made this to try to emphasize it a little bit. But this is just a line chart showing the highs and the lows in the marketplace. This is where we see the downturn, where you see my little crosshairs right now. And we came all the way down, and this was the lows of the market. We mentioned last week that we actually broke through the 50% retracement level, and let me get rid of that little mark right there. Okay. So I'm highlighting that. We broke through it, and it was really interesting. And this seems to really be happening with this type of environment. You're seeing the technicals really play out because a lot of people are wondering what to grasp as far as where do I think the market could be and where could it lead us. And we see here on the 50-day moving average, it's a simple moving average. We actually came up and touched that after we broke through that 50% retracement level. We took back 50% of the losses in the S&P 500 index. And when that happened, we had a little bit of a pullback, but now you see, and I'm trying to highlight it here again, we actually broke through the 50% retracement level and the 50-day moving average in the SPX. Now, not necessarily, if you are into the Fibonacci numbers, that just means that the 60%, 61%, 61.8% to be exact, level is in play. We had the one thing that was kind of holding us back, the 50-day moving average. That was a place of resistance to the upside, and we actually finally broke through it. We still see the 200-day moving average up here, so we still got a little bit more room to go to there. But this is some positive signs, and a couple other little things that have happened is just looking at the markets in general, we see the Russell 2000 index, the small caps, actually leading the way out of this. The last couple of weeks or so, we've seen the Russell do a little better on some days than the SPX. And today, right now, I see the Russell 2000 index is up about 2.5%, where the SPX is only up about 1% at this point in time. So
Yeah, that's certainly a good sign because Brian, you know what I keep hearing, you keep reading about it, is how it's been the FANG stocks, the big tech leaders that last out on March 23rd. Right now the FANGs make up 20% of the S&P 500. You got the information technology sector in general that makes up 25% of the S&P 500. So people are kind of raising a red flag that this can't continue forever. These can't continue to lead. I'm kind of in the camp that, you know what, I don't think we necessarily needed to see a major pullback in these big stocks to make the world right again. I think that what we might see is a bit of a pause in these stocks. And what we might see is sectors like the Russell 2000 or other sectors that had continued to underperform that are maybe usually cyclically leading retailers or industrials and material stocks. If we can start to see some of those names begin to pick up, I'd feel a lot better about the breadth of the market, which then would support also the strength that we've seen in some of those tech names, which I know are going to dig in one of the FANGs today.
Mm-hmm. All right. Yes. And so if I look at some of the things that have happened technical wise in some of the FANG stocks, specifically Google, the stock that we're going to talk about today, we'll actually see that with Google, this is now, here's the Google general chart. This is just the candlestick chart. And I'm going to highlight here. You can see kind of the moving averages a little bit better. We got the 200-day moving average right here in yellow. We have the 20-day in blue, and we have the 50-day in red. And we actually had, this is in technical.
I'm not seeing your chart, Brian. I don't know if you're sharing it.
Oh, all right. That would probably help things. Appreciate that.
Yeah.
Let's start that over.
There you go. There you go.
So now if I'm looking at the Google chart, overall, what I'm seeing here, and I got to move this box to make my screen bigger. Here we go. Is we have the different moving averages, but I'm going to highlight something that I noticed between Google and the S&P 500 index. But with the moving averages, we have the 20-day in blue, the 200-day simple moving average in yellow, and in red, we have the 50-day. And this is actually considered a death cross. I mean, it's kind of a scary name, but when you see the 50-day going through the 200-day, and we actually had a little bit of a sell-off because of that. I don't know if I put a lot of weight in it, but it did happen in this scenario. And we now see, if I go and look at the Fibonacci numbers, which I set up, you'll see a chart that looks fairly similar to the S&P 500 index. This is the S&P 500 index Fibonacci numbers. These are the Google Fibonacci numbers. So if you look at the chart, there's a lot of similarities overall. One of the things that we see, and if I put my mouse over the screen, it's going to highlight in red the actual Fibonacci numbers, is we never quite made it back to that 50% retracement level in Google. So you can kind of make the argument that Google is actually not done as well as the SPX since we've had the upturn, because we haven't actually made it back to our 50% retracement level. So we have this situation going on in Google. We got earnings that are going to be announced Tuesday after the close this week. We haven't quite made that 50% retracement level, but we do see that we have the 200-day moving average. This is right where the Google is at. If we can get a little pop to this upside based off of this earnings, well, there's actually kind of can lead the way a little bit. So you can make the argument that Google's got a little bit more room to run based off of the fact that it hasn't even done as well as the S&P 500 index, which has been contrary because Google was one of the stocks that was leading us to record highs in the SPX going into this warfare with the coronavirus.
Absolutely. Actually, if you thinking about the fundamentals and talking about earnings, if you look at the chart we're looking at right now, it fell 31% from that February 19th high. So it felt pretty hard. The market, the S&P 500 was down 34%, but it's only come back up to right now. It's, I think, or going into this morning, it was only 15% off of that February high. But if you look at some of the other FANG names like Amazon, Netflix, those names Apple have run a lot faster. They bottomed and came back a lot quicker than Google, and also Facebook too. And I think what you're seeing is as these companies are going into this quarter, and they especially think guidance for the second quarter, the June ending quarter at least, is going to be pretty negative, because obviously you think about companies around the globe are starting to think about, oh man, I got to rein in my spending because, customers are not spending as much. So their customers are companies that oftentimes have been hit the hardest from the coronavirus pandemic. So you've got sectors like retail, automobile retailers, you've got small businesses, travel, restaurants. These are all companies that use Google's search engines and services to their benefit. And so of course they're probably those companies are planning on cutting. It's easy to cut marketing and ad spend first and foremost when you're in a distressed situation. So the expectation is that guidance, if they provide it, is going to be pretty weak for this quarter. The question is, what is the second half of the year going to look like? How is that going to impact the businesses? If you look at the valuation of Google, it's, it actually has run up pretty high. So that might suggest that there is room for earnings to come down a little bit further than what the consensus estimate is right now. But I do think that sentiment going into the report is pretty negative. So it might be like a pop on the news type of day, especially when you think about and you look at the other, if you want exposure to the FANGs, if you want exposure to big tech with high quality balance sheets, by the way, here, this is one of those names, it could be a reason to buy in. Maybe this means that finally the worst will be behind us with Google. It was the first time ever that they decided to break out what YouTube and the cloud business means for them in the last quarter. So when they reported the fourth quarter earnings, they stated that, YouTube brought in $15 billion in ad revenue last year. The cloud was working on, I think, a $10 billion run rate in revenue. And, they have talked about in the last month or so, the pickup in demand for their cloud business, which could be a big boon for them as they can jump in there and are continuing to compete with Azure at Microsoft's Azure, and then the AWS at Amazon. And then obviously YouTube is a pretty interesting business that can draw on revenue to help make up for those other bets that they are wagering on and continue to lose money on. But I think overall Google is a high quality name, and that has been the name of investing, right, Brian, over the course of this last month and a half, where the pandemic uncertainty, especially when it reached heightened levels, was you did see some of these tech stocks fare better, and the FANG stocks especially, than the overall market, because we know they're high quality, we know they have good balance sheets, we know that they have organic growth, and they are the future of the economy. So it'll be interesting to see what they say on their earnings call tomorrow. Oh, one other thing before I pass it off for the options trade is, I was just going to point out too that we did hear last week from the CEO Sundar Pichai of Google, and he did confirm that they have stopped hiring new people to watch their expenses. They're evaluating what their investment spend is going to be for the second half of the year. And so they are aware of the situation, that they are being impacted by the slowdown that the virus and the pandemic has caused, and they are taking steps towards that. So I also think that's another reason that there's some, maybe downbeat sentiment going into this reporting period tomorrow for Google. But anyway, let's talk about the trade. You've got an interesting one for today,
Well,
Brian.
yeah, interesting is kind of my theme when we looked at our charts. We saw a lot of red and a lot of green in my charts. And there was a little rationale behind that, because the trade that we're going to look at today, and I'm going to share my screen this time, I'm actually going to do it and not just say that I'm doing it. And we see the chain here now in Google, or Alphabet, if you'd like. I prefer to call it Google. But if I look at the Alphabet chain overall, we're going to look at doing a Christmas tree butterfly. Now, that's just a fancy name, and I'm going to highlight it here in the options playbook. But it's a butterfly, but we're going to do it as a ratio. We're going to give ourselves a long stretch where Google would be profitable based off of their earnings, and a short stretch where we have a lot of risk to the downside. On the trading floor, I don't quite understand why this one's a Christmas tree and the butterfly is a butterfly, but it is what it is. These are the names that have basically rose to the top through all these years. So what we're going to do to start with is going to be a speculative trade. It's going to be just based on earnings. And as I usually will do when I'm looking at a pure speculative trade, I'll also toss out another trade, which would just be a long spread. And that would be the way that I would approach it if you want to go a little bit more long-term on the position. Maybe even wait for earnings to come out, get rid of that volatility, and then think about doing another trade if you think that after earnings, the upside is still there for Google overall. But once again, I want to emphasize that this is a paper trade. It's not meant to be a recommendation, especially when we're talking a little about advanced option trades like the Christmas tree butterfly. So without further ado, let's get into the actual strategy. So if I'm going to do an earnings play, first of all, I want to look at what the expected move is. And that's one of the things that's fun about the options marketplace is if you look at buying along put and buying along call on the at the money option contract, what you see here is the expected move of the marketplace. What the marketplace is thinking could happen as far as the amount of the movement after they announce. So I'm going to round this off a little bit. You got, let's call this 36. We'll call that 30. So we're looking at about 72 points is what the expected move is on Google. And I'm also going to highlight, talking about volatility, I actually looked at the chart. I'm not going to run back to the implied volatility chart, but during the downside, during the downturn, the implied volatility, the 30-day implied volatility, that's 30 days out, was at a 74% level. If I go and look at 30-day implied volatility here in Google, I could do that if I'd like. Let's run to the 30-day period. You'll see that going into earnings, and this is one of the things that has been dumbfounding me, is I'm trying to see where my date is. That's 18 days, okay. 32 days out. We see the implied volatility, 36% on a 30-day implied volatility. So vols have really came off on the stocks. And this was one, even, yes, we did have a big downturn, but going into earnings, we're seeing volatility right around 40%, looking for about a 6% move. Now, that has no regard to direction. That's just, the marketplace is just basically setting a line in the sand. This stock with these fundamentals, with everything that's going on in the market, has a potential to make about a 6% move to the upside or the downside. If it does more, that was the over. If it does less, it was the under. But that's what the expectations are of the marketplace. And so we use that information when we're picking our strikes. If I'm looking at we're going to go the most near-term expiration, which is, in this instance, it's going to be 4 days out. Trying not to move my screen so fast. Here we go. And what we're going to look at doing is going about 80 points out. So right now, the strike that I'm going to look at is the 1360. And we got Google at 1280. So we're looking at about 80 points out. So a little bit more than the expected move. So you're looking for a good movement to the upside, good news in Google, given that potential, because this is going to be a very short-term trade. And then we're going to go 40 points up, and we're going to sell the 1400 strike, and we're going to sell 3 of these. So we're bringing in a huge credit on the 1400 strike. And then we're going to protect that. We're going to go down to the 1420 strike, and we're going to buy 2 of those. So this is what makes it a Christmas tree, or a Charlie Brown Christmas tree, if you will, butterfly, is that we're going to be buying 1, selling 3, and then buying 2. The biggest deal here to make sure that your risk is covered is that you're going to buy as many option contracts as you're selling. We're selling 3 and we're buying 3. And that means our risk is level on each side. So I'll show you the profit and loss graph here, but let's scroll down to the bottom. Now that I added all these chains, this is actually the paper trade for the week. We see the midpoint is $2.35. So the reason why we're doing this trade, we're doing it very short term. Google has a lot of premium in it. So it means that we can do these kind of fancy trades a little bit and get them done for a fairly cheap level. If we were to just buy the 1360 call, for example, we would be paying $8 for that trade, but then we would have unlimited upside. So the midpoint is at $7.70. The ask is $8.20 to 1400. We're looking fairly good. We don't have unlimited upside, but we're reduced our risk from $8 all the way down to about $2.85. If we look at the midpoint, let's say we get it done for $3, somewhere in there. Now there's no guarantee we could ever get a midpoint fill or somewhere close. But if I look at that, we're looking at spending $290 as opposed to $800 on this entire trade. So every 1 by 3 by 2, we're spending 300. That's our max risk. We really want the stock to go somewhere between 1360 and 1400. In that range is a good spot where we would like to end up after they announce earnings. There's a few more days of trading because they're announced on Tuesday. So you got Wednesday, Thursday, Friday before the option contracts would expire. And I will put that trade in the right rail, and that would be our paper trade for this week. Once again, not meant to be a recommendation. We're just trying to learn here on Stock Play of the Day. And I'm going to put in a price. Let's call it 290. 285 is a really good fill. We'll call it 290. That means our total risk here is $290. Our maximum upside is $40 on this trade, minus that 290, or basically $37 would be our maximum upside. But if you actually got that, that means that the stock stopped right at 1400. So obviously you're looking for a lot less than the maximum gain in this scenario. Because you would just have to get lucky that it would go right out. I do like the fact that it is the 1400 level, though. I like round numbers when you're looking at trades. A lot of people, stocks seem to like to go to those round numbers. Now, if I look at the profit and loss graph of this, we see here's where Google's at going into earnings. Here's our Charlie Brown Christmas tree. Let me remove our paper trade over here. All right, so we see we're going to have limited and known risk if we do this trade. This is where our maximum upside is at, but we see a much steeper line to the downside as we do to the upside. So we have this long sloping upside in our profit and loss graph at expiration, and then we have a steep downside. But bottom line is, if the market goes all the way up above our long strike here, we have limited and known. All we can lose is that 290 that we paid for that trade. On this also, the same case. As long as we stay in the butterfly all the way up to the expiration date, that is going to be our maximum risk on that trade, which is $2.90 overall. All right, so I did promise that, well, that's a pure speculation trade. That's a lot of fun to look at. If you haven't done butterflies, obviously you don't want to really dive into it without learning about it and seeing how this moves after earnings. But if we want to actually do a long spread, I would just look at the June expiration. I would go out farther in time, and I would probably use the same type of concept that we're thinking a potential move could be about 6% or around 70 some points after the earnings date. And if I go all the way out to the June expiration, I'm gonna say, well, maybe you want to do this after they announce earnings. That's 39 days away, but it gets us into the heart of the summer. I would maybe buy the 1300 strike call option here and then sell the 1340. Okay, so I'm buying the 1300. I'm going to sell the 1340. That's going to give me 40 points of upside going into the trade, and we're going to be doing this for about $20 overall. So we're going to it's almost a 50-50 bet, if you will, on the stock. Looking at 40 points of upside, that's the maximum that this could trade for. Our total cost of the trade would be, if we filled at the midpoint, $1,775. It's a fear of missing out trade. Once again, we're waiting for the markets to kind of come back. This gets you into Google at a reasonable cost, and you can still participate in some upside movement if you think that Google can do this. And I would look to do this after earnings. Volatility should come down a little bit more, and it might be even a little bit more cheaper. All right. So that was a lot. Let's get into the summary. Lindsay, I think we had some questions from last.
I was going to say, before we do any summary here, first, we wanted to address some of the questions from last week and remind our viewers right now that even though we're doing this at-home edition, we can't take questions live. We will answer your questions next week. So feel free to type out any questions you have on your mind in the comments section here on YouTube, and we will get back to you on those next week. So the questions from last week, Brian, we had some good ones, some great participation. Judy Brogden asked, what is the best way to play the oil?
I talked to a lot of reporters last week just about this concept, and there are some ETFs that try to track the oil futures. Specifically, we saw something odd in that the oil futures last week, the WTI, the West Texas oil future, actually went negative last week, and that really affected a lot of these ETFs, or ETPs, I should say, exchange traded products that try to track oil. One of them is the USO. That's probably the one that gets quoted the most, and then you have the USL. And both of those really underperformed after the bounce back that we had in oil. And a lot of that has to do with the way that you roll futures contracts. There's some hidden expenses that are in a lot of these products that you need to be aware of. So if that phrase right there, roll risk, just scared you, you might want to lay down until the urge goes away as far as those ETP products, because you really need to understand that product before diving in and trading them. Now, overall, do they have a tendency to go up when oil goes up? Well, sometimes they do. And I have some numbers. Actually, I went back and did a little bit of research to answer this question. Back in 2016, we had the spot price in oil actually surge about 45%. And to let you know, at that point in time, the USO and the USL, that's the long-term futures contract in oil, USL, as opposed to USO. Basically, when that happened, the USO was only up about 6% relative, and the USL was up about 20%. Now, would I take a 20% gain? Yes, I would be very happy on a big bounce back. But the spot was up about 45%. And overall, Lindsay, actually, the numbers kind of show this. If you go back and you look, a lot of the actual oil companies, the ExxonMobil, the Phillips 66, the EOG, the Chevrons, all of those companies had a tendency to do a little better than even the oil ETPs, the USO and the USL. So that's just to keep in mind. If you're going to be trading these type of products, you really need to understand that risk. And we put a little note out to our clients actually last week to kind of talk a little bit about that.
Yeah, it's important to understand the risk, and the USO is changing the way they the product's constructed, and they're doing a reverse stock split, and so it's something you have to be able to pay attention to and stay on top of if you're going to invest in those types of products. And even with the energy companies, I would just say that history is always used for a guide, but not a guarantee of future performance. You do see some of these energy companies are starting to file for bankruptcy because of oil prices that remains very low by historical standards, and they can't operate at the prices that they're at. But some of the bigger ones, higher quality names, are more likely to survive, and they probably could. Once we see, we have more clarity potentially on the economic situation, both here and abroad, the energy companies could be ones that pop the most, given how beaten up they are too. So, so there's that.
For that. By the way, you're right. History does not indicate that the stock may continue to do that going forward. So I do appreciate that a lot. We had another question, I guess, right?
Yeah, and then there was one more question. I'll just tie it up real quick because I know we're getting to time. Is Holly McNall said, "Is it safe to rebalance these days?" And I'll go ahead and take that quickly. Yes, it is safe to rebalance these days, and this is why it's actually important to make sure you do rebalance your account once or twice a year, so that when we do get into volatile periods like this, that your portfolio performs the way that you want it to, and it's intended to over the longer period of time. So if you haven't rebalanced in a while, seems like we've gotten through at least potentially, knock on wood, maybe the worst of this. It could be a good time to consider rebalancing, but look at your options and talk to a financial advisor if you have one.
All right. So that's about it for today's show. Let's get into a quick summary. The S&P 500 index.
Yeah, the S&P 500 in the green today, on optimism about a restart to the economy and ahead of a big earnings week.
All right. And then Google, we went into a lot of detail. We got many FANG stocks that are going to be announcing this week. We got Google that's announcing Tuesday, Facebook Wednesday, Apple and Amazon Thursday. So we got a pack-filled week of earnings that should be very interesting to see what happens with the marketplace. See a little bit of an upturn 2 Mondays in a row. We've had some positive moves in the S&P 500 index. So we'll see going into next week. All right. Well, don't forget to add your questions. If you have any in the chat box, we'll try to address them at next week's at-home edition of the Stock Play of the Day. But with that said, we'll see you same time, same place next week. Thanks for coming, everyone.
See you next week.